Good morning. It's 10 a.m. on the appointed date, so having a quorum, we will go ahead and proceed with the beginning of our meeting. I'm expecting Amy Madera here very soon, but she's running behind. I did want to welcome everyone to our Oklahoma City Post-Employment Benefits Trust. Today we have some items for consideration, including the presentation of the quarterly investment report for the period. Oh, don't we have minutes to consider? Maybe I went too far. Oh, first item on our business today is approval of minutes for the November 14th, 2022 Oklahoma City Post-Employment Benefits Trust meeting. So if I could entertain a motion on that item. It has been moved. And seconded, if everyone would vote on their screen. And the minutes have been approved. So the next item on our agenda are the individual items for consideration. First, we have the presentation of the quarterly investment report for the period ended December 31st, 2022. We're also receiving our monthly investment reports for November 30th, December 31st, and January 31st, 2023. I'd like to welcome Doug Anderson to the podium. And Doug, what do you have to tell us today?
Good morning, Madam Chairperson and trustees. I did not, or raise your hand if you had UFOs on your first quarter forecast.
Let alone 4 of them. It makes you wonder how many there really are, right?
Exactly.
Yeah.
And I think that the headlines are strange right now, to say the very, very least. But the fourth quarter, we saw some improvements in the markets, some stabilization in the markets. And January was also a good month, so we'll go through that as well. First off, on this quarter, this is our year-end report, and so on the next slide you'll see, perfect. You'll see a letter from our chairman and CEO, Mike Welker, thanking our clients primarily. That's the most important thing at the end of every year. We emerged from 2023 or 2022 as a stronger firm. We had some additions to the team. We had additions to clients. We're 93 people strong. And again, our home office is in Winter Park, Florida, which is, part of Orlando.
I'm thinking we're going to need a site visit.
This is the right time of year to do this.
Yeah.
So.
Yeah.
Yes.
Okay.
Please let me know. I'd be happy to take everyone down there. So that's the gist of that. The next slide is our organization chart. Again, you can see 93 people. You can see on the upper left-hand side, that's our partnership. Those are the partners of the firm. Our firm has a distinct leadership structure where it is separate from most of the consulting duties, so there is a separation between that. You will see in the consulting department there, the upper center column there, I'm down there. You'll notice some new letters after my name, CPFA. That's a Certified Plan Fiduciary Advisor, and that's something that I passed last year. And then on the right-hand side is our distinct research department, which is helpful. You don't see these folks very often, but this is all they're dedicated to. So one thing I want to highlight on this chart is the fact that we are a professionally run organization that has distinct areas by function throughout our organization. Next slide, please, and one more. So here we're going to start talking about the market environment. And 2022 was a very difficult year. There's no two ways about it. We started with a hint of inflation during January that seemed to be somewhat pacified, but then in February, I think it was very close to this date last year, I think I remember talking about the potential of Russia invading Ukraine and saying it's a very remote possibility. But of course that did happen, and that defined a lot of the year last year. Between that and the balance between inflation and unemployment in the United States, Last year was a transitive year. We saw a lot of things changing. The next slide shows you performance in the markets. The upper side there, the quarterly performance, you saw that the fourth quarter of the year had a nice recovery. That's 7.6% return for the S&P. You can see the international equity indexes are in gray, so they had a great fourth quarter. Part of that was appreciation of share prices on foreign markets. A large part of that was also the depreciation of the dollar versus other currencies. The markets, the world economy seemed to stabilize a bit during the fourth quarter and saw the dollar trade off versus other currencies. We actually had positive return on bonds during the quarter, and then T-bills or cash at 0.9%. But then we look back at the last year, and the last year's, this is a very difficult picture to look at. Normally, when you see equities, the S&P, et cetera, down 19%, usually in that case, lower risk assets, i.e. bonds, that lower segment in green is a positive return. Those are our two major asset categories here, the blue and the green, and both of them were down tremendously. If you look at this, the only market, I guess you could say, that was positive was T-bills, up 1.5%. Now remember last year, the Federal Reserve raised interest rates almost 4% over the course of the year because inflation was judged to be non-transitory. So when you look at that 3-month T-bill return, that captures about half the rise in interest rates over the entire year. We'll take another look at that in a moment. But going on to the next slide, you see performance. Value outperformed growth even during the fourth quarter, but you look out over the last year, value, although at a loss, outperformed growth by tremendous margins. And I think I remember 2 years ago saying this growth market rally, the FANG stocks, that was the buzzword at the time, Facebook, Amazon, Apple, Netflix, and Google. This cannot go on forever because 75% of the market's return was generated by those 5 companies. And that was unsustainable. It looked like it would go on forever. It felt like it would probably go on forever. And if you were going to take a look at value stocks, i.e. banks, insurance company, and energy, you would have thought, why are we looking at this? Those companies are past their prime, they'll never generate the returns that these technology companies will. Now go on to the next slide, and we can see what happened to those technology companies. So when we look at the Russell 1000, communication services down for the year, which is the lighter column, 40%. 40% of that sector is, I believe, Facebook and Amazon, I think. They're classified very strangely. But 40% of that index is down, but that entire index is down 40% on the year. You look at consumer discretionary, obviously a slowing, uncertain market environment, those sell off also, down 36%. Consumer staples, we have to have those, so they're down, just not as much, not nearly as much. And then energy, the one standout player, right? If there was one thing that folks were very worried about last year, and we saw energy prices go, above $100 a barrel of WTI, we saw natural gas prices explode to, that's probably not it, go much higher. Very, very. Yeah, I don't like this. Let's use a different adjective on that. Adverb, sorry. But as as it went higher, as pipelines had problems under, sea, if we had other issues about how is Germany and the rest of Europe going to heat themselves, much less run industry, we saw natural gas prices go extremely higher. In the United States, we saw them go from under 2 to about 9 for a brief period of time, the price. But in Europe, we saw them go over $120 for the same price equivalent in the United States. Now it's down to less than 20 because the winter has been very, very mild. But I think long story short, the things that led the market 2 years ago in simpler times, in more stable times, if you will, definitely have taken the back seat during the last year. If you'll look, there were 2 sectors last year that had positive returns in the Russell 1000. Energy, up 64.5%, right? leagues ahead of everybody else. And then utilities, which is the most defensive sector, up 1.3%. Utilities pay a decent yield, so it's probably around 4% now, but even they, on a capital appreciation, came back a little bit last year. So when you look at the U.S. equity market, energy or nothing, that was the only place that performed well. So next slide shows the performance of the top 10 weighted stocks. And if you look at these, Apple down 26%, Microsoft down 28%. For the 1 year column there. Amazon down 50%. Berkshire Hathaway, can't get much more basic than that, right? 3.3% positive return. And then Alphabet, which is Google, down 39%. If you look there, Meta is not even in the top 10 anymore. That's Facebook. Facebook was down 70% last year. It's come back quickly this year, but it was one of the biggest losers. If you look at the bottom 10 performers, you can see some really dramatic losses here. And these are companies that we were looking at a few years ago at being industry leaders, right? Carvana, right? That's we'll buy whatever used car you have and then we'll resell it. WeWork, one of my favorites, right? They were going to completely reconfigure the office real estate market in the world. Down 83% last year, and then Tesla down 65%. Now, when we look at the top performers, therapeutics, obviously some of those are great. You see discount retailers like Burlington, and then you see Halliburton, right? And Halliburton was a great performer during the quarter, but a great performer for the year. So I'm calling it back to basics. I'm saying that cash is an investment option. Matthew and I have talked about the cash that is being held outside of the investment portfolio, because if you look at checking account balances, they're getting about 0.5% income right now, or yield on them, but the money market fund that it's invested in, it's not in cash, the money market fund is a little bit more than 4%. And if you think on $1 million, I'm going to get 0.5% or 4%, that's pretty meaningful increase. And luckily, it's been in there the entire year. So next slide, international equity performance sort of paralleled the U.S., except for it's a little bit worse the first 3 quarters of the year and a little bit better during the fourth quarter of last year. Big picture right now when it comes to international markets is obviously China. China's reopening. China coming back into the market is going to have supply and demand implications. But right now, I think that one thing in the back to basics, the world is short oil production capacity if China comes back on strong like they might be expected to. So there will be supply pressures. Europe was able to get natural gas to heat themselves this year, but the other effect was there were other countries that weren't able to, like Thailand, weren't able to get the natural gas that they're normally used to because they were bid out by Europe. So next slide, I'm not going to go over this one. If we go one more, fixed income. This will be a year that lives in infamy in the bond markets. Bonds are simple securities, right? They have it's a loan that you're making to someone in a securitized basis. A bond is simple, right? You don't have earnings, you don't have margins, you don't have anything else. You have, I'm going to loan someone or somebody or something $100 for a specified period of time. During that period of time, I'm going to be paid a rate of interest, and at the maturity of that period of time, I'm going to get my $100 back. That's it, very simply. In cases like that, securities like that, we do not often see bonds going down this much, right? I think I mentioned the 2 times in the American history where they've been down this much, and they were existential threats to the United States. It was not a year where we had 7% inflation. It was like, we don't know if the government's going to be around to pay these off when they come due. So I think the bond market may have overreacted to some of the issues, but that's also what the bond market does. We look at the quarter, things finally started to come around nicely, but the aggregate bond index for the year was down 13%. That's our main benchmark here. Treasuries were down 12.5%. Mortgages down 11.8%. Corporate bonds down 15.8%. High yield were down 11.2%, which is less, and there's couple of reasons why. But ironically, in a year that the bond market sold off, you had corporate bonds that were investment grade, and you had corporate bonds that were below investment grade. Below investment grade bonds performed better. That's because they have shorter duration and they pay more income, and that's why they did better. It was a year that, in the next slide, please, where we saw the yield curve. On the bottom there, you can see the Treasury yield curve. This shows you the yield of Treasury bonds on various maturities at 4 different dates. So the first one, or the lowest one, is 3/31 of last year. So this is, the very beginning of the interest rate hiking cycle. And you can see that the yield curve was fairly normal. It was low, but it was fairly normal, with a yield of 25 basis points at the front end and about 2.5 at the 30-year. Now look at the yellow line there. That's very interesting, where the 1 month went from 25 basis points to about 425 basis points. That's a rapid increase in interest rates by the Federal Reserve, trying to reduce inflation in the economy. And so that's one thing. The other thing that's very interesting here is that the yield curve is inverted, meaning that you can make more money lending someone 6 months than you could lending somebody for 7 years, right? What does that make people do? I'm not going to lend money to anybody for 7 years. I'm going to do it very, very short term. And so that has a slowing effect. And I think the old saying is that an inverted yield curve is predicted 7 out of the last 5 recessions, meaning it does not always precede recessions, but it usually does. So this is some sense of economic slowing in the future, just because the way the markets work, the way the markets fund themselves. So that is the long and short story of the market environment. If we could go to the portfolio report itself, like I said, this is a very difficult year, down 17%. This is one of the most difficult years that I've ever seen as an investor, as an advisor to folks like yourselves. This feels as bad as the 2008-2009 period, the great financial crisis, where it felt like the world's financial system was going off a cliff and we didn't know if it was going to be there. I think it's going to be there. We might have a slower economy this year. We started with interest rates very, very low, which was punishing for the bond portfolio. But if there's one positive that I will say out of this, expected returns for 60/40 portfolios at the beginning of last year, given how low bond yields were and how high or how expensive stocks were, it was about 4.2%, right? 60/40 portfolio. This year, because equities are down, but more importantly, because bond yields are up, that same 60/40 portfolio has a forward-looking expected return of 7%. So I guess that's the shiny side of the penny that we just picked up on the sidewalk there. But we're not invested exclusively in those 2 asset classes. We're diversified beyond that. And I think that this year it helped us in ways I certainly didn't expect. So next slide, we'll go on here. You can see that over time, the strategy has worked, right? The long-term asset allocation has increased the value of the portfolio. At this point, at the end of last year, it was $85.6 million. So this is December 31. This goes all the way back to 2009. We started with $6.018 million. And as we ended the year at 85.6. Over that period of time, we've seen $151 million contributed. We've seen $105 million pulled out. We have seen gains on market value or capital appreciation of $33.3 million. The ending market value is right there. We've also seen income of $11.1 million. And hopefully in the future, we will see a larger contribution of income to the total return here. So over the entire period of time, the cumulative return has been 140%. It's a great time to be invested. We have had some shocks to the system there. One thing I will note, I will show you, is that we have not seen 3 negative quarters in a row like we did see last year. That was the first time we saw that. Now, we saw a strong rebound during the fourth quarter, thankfully. And that $52 million is the net, I guess you'd call that the corpus that has been, or the net of all positive cash flow over time. So the amount in total contributed is $52 million. We still have 85.6 after what I would consider one of the worst years that we've ever seen. Next slide, please. Asset allocation has been roughly stable. It's been stable over time. You can see we started out slow with less domestic equity, and we supplanted that with fixed income because, again, 2009 was a period where we didn't know what was going to be happening next. Next slide is our asset allocation here. So we have 63% domestic equity, 16% core fixed income. We have 11% in non-U.S. equities. So our total allocation to equities is about 75%. We're active that way. We are more in equities than a lot of folks. And actually, ironically, last year, having 16% in fixed income didn't help us as much as we thought it would. So that's one of the reasons that we have that return. You can see we have a couple of other fixed income allocations, and then 0.2% in cash. This is cash in the investment portfolio. Matt, how much is in the outside of the investment portfolio? So outside of this, we have the cash buffer, which is about $2 million, which allows us to not to have to hit this portfolio on a quarter-by-quarter basis. The next slide, please, is our manager allocation. Here you can see largest is our S&P 500 index fund, then our international equity, then we have small cap U.S. equities, mid cap U.S. equities, and then bond portfolios managed by Loomis Sayles, Double Line, Hoisington. Well, then we have our mid cap portfolio and then the Lord Abbett High Yield. So at the very top of the portfolio is a passive exposure to the U.S. equity market. Bonds much lower. We have half of our mid-cap exposure is indexed because we kind of went round and round trying to find the right manager there for a while. All of our international equity, all of our small cap is actively managed, as is our equity portfolios. Next slide, please. This shows the transfers in, very low activity during the fourth quarter of last year, but you do see that appreciation of $5.4 million and income of $832. Next slide, please.
Doug, I have a question.
Of course.
Really quickly. Do we typically maintain that $2 million, have that $2 million in cash on a quarterly basis? Do we try to?
So we've got a floor that we've set around there, and as the contributions come in and it gets higher, we'll say, okay, Doug, we have about $1 million to invest.
Okay.
Go from there, and then you go based on what our allocations are. Here's where we should put that money.
Okay.
We try to keep an amount there to cover all the claims.
Okay. Thank you.
And Trustee Barry, that's been an, I guess, a evolving area, and I think it's smart to have that much cash on the outside because in a worst case environment, I would rather have that and not have to tap assets when they're down. So looking at the portfolio here, not a lot of surprises, right? You have more equity than most funds out there because this plan has a very long time horizon, possibly exceeding our own lifespans. For the quarter, portfolio was great. It had equity exposure. It did very, very well. It had international equity exposure, which helped it. So overall, it was up 7.81%, which outperformed its benchmarks and ranked in the fourth percentile of its peer universe, first highest, 100th lowest. Now, remember, if you're in the top 5% during the sharp recovery, don't be surprised if you're in the bottom 5 percentile during the market decline, right? There's no magic bullet. We do what we can. But in a market environment where almost everything went down last year, you have market exposure, you're going to go down. So the loss, you can see down 16.95. Now, going to the quarter, going back to the quarter, you can see that our fixed income exposure was up 1.1%. We had widely dispersed returns there. Loomis Sayles, 2.81%. Well, thankfully, all but one were positive. Second percentile. Double Line Bond, which is a more macro-oriented portfolio, 1.13%, but they ranked in the 92nd percentile. And then Lord Abbett, down 3.75 in the 71st percentile. And then also, I said irony once, I don't want to use that word again, but surprisingly, Hoisington was down 1.95%, and they had an absolutely rotten year last year. Their economists, the biggest economic surprise last year was that inflation was not transitory. It fooled the Federal Reserve, it fooled the Treasury Department, it fooled Wall Street, and it fooled these folks too. Although their rationale still appears to be sound going forward because they are expecting a slowdown, it did not help their portfolio a bit. That's why we have a reasonably small allocation here. And in market environments in the past where equities went down, this portfolio went up in the opposite amount. Or if the market was down, equities were down 20%, this portfolio would be up 20%. And I'll show you an example of that in just a moment. But in this case, because inflation was driving the market uncertainty on the equity side, it also hurt this portfolio, which is invested 100% in U.S. Treasury bonds.
So Doug, I'm looking at the historical information for Hoisington.
Yes.
And they've historically underperformed the benchmark pretty significantly.
Yes.
Are they on the watch list?
I don't recall if they are. I think we talked about it last quarter. And I don't have a paper report in front of me. Can we wait until we get to that part?
Absolutely.
If not, they should be.
Yeah.
And before we move on to that, can you move 2 slides forward? This is one part of the picture that you don't see because last year was so awful. Hoisington has always been a very volatile manager. They own long duration U.S. Treasuries, which have the highest volatility within the bond market. Sometimes that's bad volatility, sometimes it's good volatility. So you look down here, you can see the year to date. Gosh, I hope I never see a return like that out of the bond market. Anything that pays interest and has maturity date, much less U.S. Treasuries. I don't ever want to see that again. But you look at 2021, they were down 4.9, which was bad too. But you look at 2020, you look at 2019, you look at those returns. That's what they're capable of. Unfortunately, those 2 years that we've had recently completely obliterate that from the record that we look at if we stop it and look back from 12/31. So it's unfortunate that they were down that much, but they do have some utility in the future. I want to make sure that they know that we're watching them very carefully.
So there haven't been any changes in management, any significant changes that you're aware of? Okay.
No.
That's
So
what I was
Strategy
wondering
changing.
about
Yeah.
too. Did they change their
Strategy,
mission statement or?
no, nothing. This happens to be probably the simplest investment strategy that we have. They look at the future of interest rates, which is the future of inflation, and they construct their portfolio to produce an absolute return based on that forecast. They expect a slowing economy, which means that they will own 30-year treasuries. If they see inflation going higher, they will own 91-day T-bills. Their portfolios are almost binary. They missed inflation coming up last year. So they held at the 30-year treasuries, and this is what happens. A 1%, remember, a 1% move in a 30-year treasury, if interest rates go up 1%, that portfolio will be down 18%. If interest rates go down 1%, portfolio will gain 18%. So it's a higher volatility strategy. And in other cases, I mean, 2020, you remember that was the first year of COVID and the equity markets went down dramatically. They went the opposite direction. But these are all great questions and things that do keep me up at night about Hoisington. If they're not on the watch list, they definitely should be. But I wanted to make sure that we had the whole picture. Endpoint sensitivity when you're looking at returns is real, right? If before we turned to this slide, if I said, they were up 20% in 2020 and 17% in 2019, that'd be hard to believe, looking at that 2022 look back, but it is the case. So thank you for your patience on looking through that one. It's not a simple issue, although that is the simplest portfolio we have. So could you get back 2 slides, please? Thank you. So that's our bond portfolio. Our equity portfolio for the quarter was up 8.41%. That's for the year down 17.57. So we definitely did not close the year at the lows. If we look down the first three portfolios, you can see for the fourth quarter. And again, the S&P 500 is by far the largest one. It's almost it's a little bit more than 1/3 of the assets. $31 million, up 7.56%, 57th percentile, which is about what we would expect. And then 18.13% loss, which is slightly worse than the benchmark. Again, acceptable ranges. Same is true for the index fund. But I always like to have at least one positive thing to look at, and that would be Hotchkiss & Wiley. Hotchkiss & Wiley 2 years was the one who was investing in things that would never go up again. Their portfolio is unchanged. They're patient. Portfolio is still relatively cheap. There is a lot of energy in this portfolio, both literally and figuratively. Their largest positions are in the energy complex. So we do have a portfolio that is actually positive for the year, 1.78%, while its index is down 12. What's astonishing is how high that 3-year rate of return is. I mean, compounded at 12% over the last 3 years, given the worst combined bear market that we've seen. I just want to say thank you for your patience on this one. I'm sure it was tempting times to say they don't know what they're doing. It's time to get rid of them. If we do need to take money from a portfolio this year, this will be the one, right? We will be taking profits from it, and that's part of our discipline. So the next slide, we're going to go on to 2 of the other equity portfolios. And again, the Stevens small cap portfolio is slightly worse than their benchmark. Over the last 3 years, 5 years, and 7 years, they're above median in their universe. This is not a hyper-aggressive small cap growth portfolio, and we like it that way. But then look at our Causeway International Value Fund. Remember I said international equities came back. They stormed back during the fourth quarter, and you can see that this one was even a little bit more than that. So 11% of the portfolio is up 22% during the quarter. That's a remarkable snapback. But also remember that when markets recover, when they turn the corner from bear market to bull market, it's the early stages where you see the most dynamic returns. So their last year, they're down 6.76%, which is 20th percentile. That's a lot of time spent on returns. Do you have any more questions before I move on? Thank you. I'm going to jump ahead a few slides here. So this is one of our bond portfolios, a little bit of volatile return. You can see that their returns are higher on the scatter plot, but they are a bit more volatile, and that was good for them last quarter. Next slide shows one more. Double line, which is a little bit different. They don't do things the same way. They're more macro-oriented, meaning they'll invest more in mortgage-backs and have interest rate strategies, and so they have trailed off since 2020. Next slide. You can see long term, they're not bad. They're really close to their benchmark. Next slide. Lord Abbett, this is our high yield fund. Again, it was one of our better performers for the year. Keeping a low watch on them. They haven't had any major personnel changes, but I don't like the deterioration. When the blue line goes down, that's not good. So keeping an extra eye on them right now. And then one more, please. So this is the Hoisington experience, right? We've been through this. We've had them for some time. They are either the best or the worst. And unfortunately, I wish they weren't always the worst, but they're a hedging portfolio that does some volatility, has some positive effects on volatility. So next slide, we're going to be going over our index fund. You can see this doesn't have a 3-year history because remember we moved to a share class that was extremely cheap, the cheapest index fund out there. Next slide. So we have 1-year history there. Going on to the Hotchkiss & Wiley portfolio. On the lower left-hand side, you can see when the blue line was at the bottom, that was when I was pulling my hair out, and we were very impatient with them, but knew they had a good process. They had a good process, they had good patience, they had good personnel. And so now what we see is they have gone from the poorest to the best. And again, it's important to pair portfolios like this back when they do well and add to them when they're not doing well. Sort of the same, I'd say the same thing about Hoisington. And then next here, Next manager, index fund doing exactly what it should on the mid-cap side. And then the one more, you can see our this is our small cap growth portfolio. You can get pretty aggressive in small cap growth. I tend to want to be less aggressive in the really volatile asset categories, and that's the portfolio that we have here. And I like it. I like to be less aggressive with higher returns. On the risk return plots there, the scatter plot with the 2 dots on it, there's no better place to be than where they are on the left-hand side. So that means higher return and lower volatility. That's exactly where you want to be. So I think we're getting really close to the end here, but I need to highlight a couple more things. One more, actually, Causeway, great recovery during the fourth quarter. Another one, please. So let's go some more here, another one. So this is our table of correlations over the last 5 years. This means how do our assets perform versus one another? When one's up, are they all up, or is there one or two that are down? In the last year, we saw really high correlations because both stocks and bonds are down. That's unusual. If you look at the column, the fourth one over called Hoisington, if you take a look at that, you actually have negative correlations, albeit small. Let me explain the scale. The scale is 1.00 means perfect positive correlation, right? If one asset goes up 10%, the other one's up 10%. If it's negative 1.0, that's perfect negative correlation, meaning if one's up 10, the other one will be down 10. We like to have negative correlations on assets because that's diversification in statistical terms. We have one asset, Hoisington, that they have negative correlation with most of the other asset categories and very weak correlation with the total fund there. You will notice that our correlation of the total fund on the bottom line, it is relatively low with our bond portfolios, but it is much higher with our equity portfolios, which tells you equities are the generating asset class, and our portfolio is geared more to equities. So next slide. Again, update this one to on watch, for Hoisington. I think they would be surprised if we weren't taking some notice on the portfolio. And then fees. Fees are very, very important here. The expense ratio on a weighted average basis is 44 basis points. The average of those categories, when we total it up at our asset allocation, would be 90 basis points, which means that we are 46 basis points less expensive than average. So we're paying half of average in the mutual fund world right now. We are below in every category except for Hoisington, which is slightly above, and makes me watch them even closer. So at the total market value at the end of the quarter, which was $86 million, the annual savings through selection of low-cost funds is $352,000. So that's good. And then I think that is it for the quarterly report. Can we go another? This is the dashboard where essentially no surprises here. So any questions on the quarterly report? Could we move on to the, can we do the 131 first, please? Perfect. So this is the January 31 update. And we closed the year, you can see positive. We had a positive start to the year. Russell 1000, Russell 2000, in non-US equities, and even fixed income had a nice return during the month of January. Next slide shows this, sort of spoiling the punch here, $91.8 million. That's 1 month. That's a good month. I'm going to spoil it even worse and say that as of last night, we were still at $91 million. So we've maintained that. That's good at a volatile month. And then the next slide shows the return. So the month, 7.18%, which is good. For the quarter, we're up 8.82. For the trailing 1 year, can you believe that 1 month, you drop 1 month off, and we go from a loss of 16.9% to a loss of 6.9%. This is how returns work. Remember, we're looking to the far side, the 3 years, the 5 years, since inception, which doesn't change much at all over time. But the quarter was strong. You look at our bond portfolios, For the month, you can see we're up anywhere from 3.09 to 6.47. You can see that when we look at what all of those, our bond portfolio for the year to date up 4.57, which is the month. But for the quarter, the bond portfolio is at 8.12%, and who, of course, is the leading performer there? The most volatile manager, it's Hoisington, up 12.76%. Again, slowing, uncertain economy, they're going to do better. When we look at the rest of our portfolio, on the equity side, up 6.41% for the quarter, and again, usual suspects lead. Hotchkiss and Wiley, again, energy-based portfolio. They are fairly courageous, I would say that. Not a lot of other folks were holding energy 2 years ago, and they're holding a lot of the same names. Had a talk with a portfolio manager last week. Does he see anything changing? We're hearing a lot of scrutiny on the big energy companies right now. You're making all this money and you're not going to, drill any new wells or anything back. You're just going to reward shareholders, and that's probably going to continue to happen. The one thing that I did ask Stan about is share buybacks, which is a popular way to reward shareholders when things are good. There's a 1% tax on share buybacks right now for domestic companies. He said that could go up, but if that were to happen, they would probably shift the balance between share buybacks and dividends. So there are multiple levers there, and I did remind Stan also that don't fall in love with energy. There are other cheap parts of the marketplace out there, and he's absolutely. Value managers can be that way. Once they hold a trade for a while, think about it. He's held these for 5 years. They've only performed great in the last 2. He sees a lot of runway ahead of him. It's very tempting for the investor's mindset to say this is just going to go on forever. And then you can see Causeway had another great month, and that led to a 26% return for the quarter. And very interestingly enough, we have 2 portfolios with positive returns for the 12 months ended 1/31, which is a remarkable turn. Those are both value, they're both equity managers, and that is kind of what you do see when markets turn from dramatic downturns to rises. So any questions about this? I'm not going to say it's over, but we're thankful that we have had a respite from the volatility. Just a minute on the market slides here. I'll take just a couple of minutes here, put some things in perspective. This is long-term market history. I think we've been through this. We are still, we have drawdowns, we have increases, and over time, the market does go higher because of what it represents. Next slide. This is the bond market, right? It's going to take a while longer for the bond market to recover, but it has recovered quickly in the past. You can see, sorry about that. If anybody was starting to get bored, it's a wake up. If you look at the drawdowns of the bond market going back to the 80s, or 76, it doesn't go down very often. It never has gone down as much as it did over the last year. And if you look at what happened in the past, so March 1980, September 81, June of 1994, you can see those are the drawdowns. And then we look at what happened to the bond market after that. And you can see the returns were strong, right? For the 1 year after the bond market, the bottom of the bond market declined, 10.5%, 34.5%, and 12.55%. So the returns can be strong going forward, and we've kind of seen some of that. Next slide. I think I'm going to end with this one. This is a scatter plot. So this shows you in return space what returns generally look like for the U.S. equity investor. And that's assuming that your two biggest asset classes are S&P 500 and the aggregate bond index, right? So the vertical shows you the return of the S&P 500 for each of these years. So 1985 or 1982, that return was about 21%, right? And then if you look at the horizontal axis from left to right, that shows you the return of the bond market. So when I'm looking at these years, 1982, the equity market was up 20%. The bond market was up 32%, right? That's what that shows you. In this case, the best place to be is the northeast quadrant as you look at it. So that's phenomenal. Where are we? We're at 2022. I argued that dot shouldn't be green, but that's because our corporate color is that color. It should be red. I know it all feels that way. But on that column, you can see that the bond market was down 18% and the stock market was down 13%. Again, nothing anywhere near that. Even in 2008, which was the financial system and the world economy at the point of maximum uncertainty and pessimism, bonds were still up about 5.5% that year, although equities were down worse than they were. So this is what last year looks like compared to other years going back to 1976. And so with that, I will pause for questions.
Diana, no questions for Doug?
Well, you know, I do have a question. What percentage of our portfolio, if any, is invested in China?
Ooh, that's a good question. I will have to get back to you. I can get back to you before I leave today. But it is, if we, I want to answer that, give you a good question. It is not, our international equity exposure, the total is about 10%. I'm going to ask you to go to one slide for me really quickly, and it's in the 1231 report. It's near the beginning. Keep going.
It's okay. I think it's a very good question.
I think it's a wonderful question there. So this is the benchmark index that Causeway uses. If you look on the right-hand side, this is international equity. So we use what is called the ACWI index. That is the all-country world, ex-US. So it's all countries in the world except for the United States, and it's weighted on a GDP basis. So that gray column tells you the weighting. If we go down all the way to China, 9.2%, and I'm saying if they have a market weight of China, which they do not, 9% of 10% is a little bit less than 1%. That is my approximation. I will get a better figure for you before I leave. Interesting, when we look at that, though, the one thing that comes to my mind is when you have China at 9.2% and you have Taiwan at 3.9%, those two might go negative at the same time. That is 12% or 13% of the 28% that's emerging markets. So they're almost 40% of the entire emerging markets complex is in those two countries, which I'm cautious on them right now for a lot of reasons. One thing also to notice, there's no Russia in that index anymore. If you remember last February, yeah, now they were part of the index. It was relatively small last year, but the Morgan Stanley Capital International, that's the index provider, said you're out of the index, which means that you're virtually uninvestable. And if you had any holdings, which we did, tiny bit, in Russia, it's been marked down to zero, and you still cannot trade it. So that's a great question. Let me get the better answer for you. That's an approximation. I'd say it's less than 1%. Thank you.
Thank you.
Okay, if there are no other questions for Doug, I assume we do not need any action on A. So our action would be to receive the monthly investment reports for November, December, and January. I will entertain a motion. What am I doing wrong here?
Okay, you're my first test case.
Oh, good, I'm the first test case for IT. Hi, Alan. He's waving at me. Okay. Do we have a motion?
We do.
Okay.
Andy and Neil.
Yeah, mine's not showing a motion or a second, so it's been moved and seconded.
How would you
So
like to vote?
I will entertain the vote, and I will vote yes to receive the reports. All right, and that has passed. So our next item is the acceptance of the annual financial report for fiscal year ended June 30th, 2022. I'd like to welcome Rhonda Dugan from our accounting division.
Yes,
Thanks, Rhonda.
Good
And we call
morning.
it the ACFR now, so not the CAFR anymore,
not the CAFR
right?
anymore, no.
No.
I just have a few points to make about the June 30 financial report. The first point is, if you look on page 1, the financial report was given an unmodified opinion from the independent auditors, which is what we want, and the full report can be found on page 1. And then from there, if you can turn to page 9, and the statement of plan net position, what I wanted to point out there is that at June 30th, 2022, the trust reported a net position of $85.86 million. This is a decrease of $11.6 million over the same period when the net position was $97.47 million. And this is primarily attributed to the decrease in the fair value of investments of $11.57 million at that point in time. The next thing I would like to talk about or point out is the funded ratio. And if you can turn to page 35, there are going to be several pages, but the trust funded ratio looks at how much actuarial liability the trust has versus how much the net position or money it has to pay that liability. At June 30th, COTPA could pay 52% of the liability with the funds that it has, and that's an increase of 3.9% over the prior year ratio of 48.1. The city could pay 22.1% of the liability, and that is an increase of 3.4% over the prior year when that funded ratio was 18.7%. Now, if you look at page 37 through 41, or excuse me, through page 40, it'll show you that COTPA and the city have had a steady increase in their funded ratio since 2017, when the funded ratio started at 19.8 for COTPA and 8.5 for the city. Those are the points that I was pointing out, and that concludes my report for June 30th. If there's any questions, I'd be happy to answer.
Thank you, Rhonda. Does anyone have any questions for Rhonda?
No questions, Rhonda.
Okay.
Thank you very much.
Would you like me to go ahead and talk about December?
Yes.
Or do you want to?
Let's go ahead and vote on
Okay.
our acceptance of the ACFR first. Okay, we have a motion and a second. If everyone would vote, the ACFR is accepted.
Thank you.
You can go ahead and move on to the next item, which is the acceptance of the interim financial report for the period ended December 31st, 2022. I hope that just like Doug lifted our spirits with the monthly report, that you're going to do that
I know.
for us.
This one here, I only have one point I wanted to talk about, and it's on page 6. And I'm just turning that, and that's the statement of changes in plan net position. At December 31st, 2022, the trust reported a net position of $86.75 million. This is an increase, so that's great, but it's only an increase of $885,000 over June 30th. So we are starting to see an increase in it. This is attributed to $1.61 million in net investment income contributions, $13.03 million offset by benefits paid, and administrative expenses of $13.76 million. And that's all I have for December. It's very short and sweet.
Okay, thank you.
Thank you.
Does anybody have any questions for Rhonda on the December 31st report? All right, hearing none, then we'll entertain a motion on that item. It's been moved and seconded and approved. Thank you very much. So our next item is to ratify and approve the issuance of a request for proposals advertised by the City of Oklahoma City and the Oklahoma City Municipal Facilities Authority for a self-funded and fully insured medical prescription plan for the city of Oklahoma City and participating public trust employees, retirees, and eligible dependents, effective January 1, 2024. I'd like to welcome Jason Long to the podium. Jason has appeared before us as the interim total rewards manager, and today I'm happy to present him to the trust as the permanent permanent total rewards program manager. Thank you very much, Jason. You have just a few introductory remarks regarding this RFP.
Yes, I do, and thank you, Board, for those kind comments.
Congratulations.
Thank you.
Yeah.
This item originally appeared on the January 17th City Council agenda. It was a joint resolution between City Council and OCMFA, and basically this item is just to ratify and approve through OPEB the issuance of the medical RFP. One note I would want to make real quick is that we did not include the Medicare Advantage plan as part of this RFP, and the primary reason for that is because we went out for proposals so early in the year, and typically CMS does not give their initial guidance for 2024 rates until February of this year, and actually we're going to have some virtual meetings later this week to get additional information on that initial guidance for 2024. So it's a little premature to go out for the MAPD. We're looking to release that RFP at the end of this month so that our vendors will have more guidance as to what they can actually bid on for 2024. With that, is there any questions? Okay.
No, I think I do want to just point out that due to the timing of our meetings and the frequency of the city's meetings as well as the MFA, it's going to be sometimes important that we move ahead with an RFP before this body actually gets to review it. But I do want to say that in the event that you were to find something in the RFP that was of concern to you, I'm sure that we could bring that forward to our trustee, Amy Madera, and she would make sure that that comment was incorporated into whatever pre-proposal conferences or negotiation strategies that the city might undertake in the actual final product of that benefit package. So while it is necessary for us to keep the business moving, we wouldn't want to have even our retirees affected by a lapse in those services and benefits. There is still an opportunity for the trust to make any concerns known to Amy in this process.
Thank you, Chairwoman Johnson. That's correct. Feel free to contact me or Jason. We'll be happy to be able to address any concerns that any of the retirees or this board may have questions on.
Okay.
And also, just for full disclosure, probably for I guess our next meeting will be in May. There will be items out there for not only the MAPD to ratify that RFP proposal, but we will also be looking at a proposal to ratify our group life product, since retiree life is a component of that as well. So that should be on the next agenda.
Thanks for the heads up.
What's the response date on that RFP that's out?
Currently, we have the deadline to be next Wednesday, February 22nd.
Okay, if there are no other questions or comments regarding this item, I'll entertain a motion to approve and, ratify the issuance of the RFP. It's been moved and voted.
Do you wish to vote?
Yes.
Aye.
Yes.
Let's refresh her just for testing. We're working with IT.
There we go.
Awesome.
Now I don't have a moved and second.
Because you've already been,
I'll enter your vote.
okay, she'll enter the vote. All right, thank you, Jason. That item is approved. All right, next on our agenda is to ratify the claims for November 9th, 2022 through January 31st, 2023. I'll entertain a motion on that item. Moved and seconded. Waiting. I vote yes. Everyone, Neil?
Waiting.
Oh, okay. Everyone.
Yes.
Unanimous waiting. Okay, that item is approved, claims ratified. The next item on our agenda is comments from trustees, staff, and interested parties. Neil? Diana? Amy? Okay, no comments from the trustees. Matt, do you have any comments? Jason, any comments? All right, then we are adjourned. Thanks, everyone.
Steve, Madam Chair,
Thank you.
interim acting chair.
Interim, pretend, almost, chair.